content of this podcast is produced for entertainment purposes only and is for informational and educational use. It does not constitute financial or investment advice. You should not make any financial decisions based on the information provided without consulting a qualified professional. All opinions expressed are solely those of the host and guest and do not reflect the views of any company or organization. The hosts and or guests may currently own, have previously owned, or intend to own securities discussed in the content. The content produced here belongs to Daniel Andreev of 18 Degree Journal and cannot be reproduced or used without prior permission. We do not wish for this content to be used for AI training and do not give such permissions. WriteUp. A hidden gem with shareholder-friendly management. HME. Hola. I guess that's different than saying hello. Maybe partially inspired by the Super Bowl, but let's keep it rolling. Today's write-up's a little bit differently. I'm going to a different sector that I haven't written a background in yet. And as always, please keep in mind the disclaimer. I may or may not hold a position in security. This is only for entertainment purposes and educational purposes only. I think it's not presumptuous to say that Canadian oil markets are filled with, their own cues of drama, with big consolidated players. Of course, world-renowned junior wildcatters trying to make their own fortune. And of course, it's all operating by a lot of whims from the United States. However, as the world's fourth largest proven oil reserve country, trailing approximately, let's call it 171 billion barrels, with over 95% located in Alberta's oil sands. The statistics are all according to Natural Resource Canada, with only three other countries having more, which is Venezuela, Saudi Arabia, and Iran. It's not far-fetched to take a closer look at a few players for opportunities. I decided for fun to learn more about the industry and look at the companies not through the lens of, hey, if crude goes to 100, we are golden, but in the lens of resilience, the companies that right now making a healthy profit with a high margin of safety if oil prices collapse, and the same time would participate in the upside if oil prices spike or price of WTI and WCS converge. This search led me to a very interesting company, being Hemisphere Energy. It's traded on the Toronto Venture Exchange under the ticker HME. Also traded over the counter in the States, ticker HME and F. It's headquartered in Vancouver, and a majority of its operations are in Alberta and Saskatchewan. So, company at a snapshot, originally founded in 1977 under the name Northern Hemisphere Development Corp., renamed to the current name of New Hemisphere Energy Corporation, in 2009. It was a junior legacy player with minimal operations. At one point, it just had 10 barrel of equivalents per day of natural gas. In 2008, due to the fortune of a singular golf game, the company transformed from a rival with Don Simons, a professional geologist who took over as president and CEO. Don came with technical expertise and the experience in Endicana Ortiz, I can't pronounce that, and Sebring Energy. From my understanding, he helped actually sell it at a peak in 2007. And with him at the helm, what was effectively a blank slate corporation was transformed, along with the talents he brought on, to operate under a new philosophy, to find oil that was discovered decades ago, but economically stranded, and use modern engineering to get it out. HME stopped chasing exploratory lottery tickets and focused on acquiring underexploited assets in southern Alberta, specifically the Adley Buffalo properties, and generating predictable profit streams with a corporate structure that is explicitly shareholder-friendly in its capital return policies. The business model is quite simple. HME has some of the best assets really close to the pipeline, with the apple flowing to a refinery in Montana, with currency hedges and oil hedges for short-term volatility. What makes the company truly unique is that they utilize polymer flooding enhancement oil recovery, EOR techniques. To simplify what that actually means or what the process is, it's essentially a process that involves pumping specialized liquid to make its way through cracks in the rock formation to push more oil out. It's better than traditional water-based methods as the solution is thicker and acts sort of like dish soap and pushes oil uniformly. This method flattens their production decline rates to approximately 5 to 10%. A very impressive junior industry average is around 20 to 30%, meaning avoiding expensive or constant drilling to keep production flat. This strategy with the generation cash, it paid down debt. The strategy of the corporation is to generate cash to pay down debt, which at the moment they have none of, pay dividends to buy back shares, and use some but not majority to explore other high promising areas. They keep these values very conservative for future businesses once current wells go dry. So some of the numbers, I have a pretty good illustration in my article that you can check out that explains it basically bare bones. So if we just take it per barrel, and this is the data of Q3 2025, revenue per barrel is roughly $70 Canadian. Royalties are about 18%, which over that from 70 would be $12.44. Operating cost $12.66. Transporting cost $2.84. And operating fuel netbacks about $42.49. And if you realize the hedging loss, that's about $1.10. So that comes down to operating netback of $41.39 per barrel. Management explicitly stated that the break-even price is somewhere in the 20s Canadian for their operations. So the company produces an average for that quarter, at least the last that we have information for Q3, was 3,571. Projected to return back to 3,800 by 2020's November, I believe it was, and 3,900 for 2026. Again, take projections with a grain of salt. The company produces roughly 99% of its heavy oil, the other 1% being natural gas, with a 5 to 10% decline rate like that above. Reserves as of the end of 2024 are proven to be developed producing of 9.3 million barrels, total proven 1P 11.4 barrels, and proven plus probable 2P is 14.5 barrels. The company market cap today is around $200 million Canadian, and you can view the cost structure below that I mentioned in my image for understanding how the break-even price is again around $20 Canadian. If we just do back of the envelope calculations and show possible undervaluations, if we assume similar conditions to today, aka WTI at 60, world differential stable, currency at around 70 cents, they produce annually roughly 1.39 million barrels, and that will account to approximately 35 to 45 million Canadian in annual adjusted fund flow rate. That is about, we'll call it 18 to 22 in cash flow yield with 4.5 year payback period. Now, if we include the 11 million of working capital and no debt and see the wiggle room to be wrong, and we take the reserves from 0.64 to 1p, so that's $30.33 a share, or 52 cents per 40 cent, we can see some sort of opportunity. Thesis summary kind of reckons around an idea that Charlie Munger popularized. I believe this was in one of his speeches or somebody else talking about him, talking about how Charlie Munger viewed the oil industry, or not the oil industry, my apologies, the tobacco industry after the ban of TV advertisements. And he said that the ban forced companies to stop initiating capital expenses on ad wars to fight for market share, and instead of returning the capital to shareholders, which created predictable cash flow streams, and new incumbents couldn't really enter the field because they couldn't, get in the mind of the consumer. He applied similar logic when he talked about his only investment from Barron's magazine, a newspaper to be more precise, which helped him buy the California oil driller Belridge Oil, and were very similar philosophy because they didn't need to drill new wells and they were just milking this one well out. You could predictable cash flow straight from the well to his pocket. This logic flow is also speculated to lead Berkshire to invest in oil in the last couple of years. And this thesis of redirecting capital back to shareholders, not new drilling projects, is what basically drives the value of this idea. The thesis is very simple. If management keeps their promise of continuing returning the patterns, the returning cash as they have, prioritizing that over new projects that don't make economical sense, we can have a sort of cannibal stock, or a stock that will grow only through very intelligent acquisitions. And the CEO has shown restraint in purchasing new projects or risking his capital. So in conclusion, I hope you really enjoyed this. I try to keep it really short, kind of new style, under 2 pages. Quickly tell you what it's about. See if you like it. See if you don't. More detail if you're interested. Keep an eye on MLCI. I'm going to do the write-ups later this week. I'm almost done it. And I hope you enjoy your weekend. If anyone has any more insight, please reach out. Let me know. I'll be all comments. Cheers. It's Daniel.